Well, so welcome everyone. Today we have a seminar and we are going to have 2 hours on Pillar 2. And we have here some guests here in the Faculty of Law at Leiden University. And we also have some guests online from Canada and from the US. And so today we are going to, I think that I will leave it up to you, the effect of the Pillar 2 and the effect on tax regimes. We will start first with Professor Kerrie Sadiq and Professor Frederik. Perhaps you can introduce yourself, and I will just let you start. I think that everyone knows me, so that's fine. We know that one project. Okay, so.
Thank you, Irma. So, my name is Professor Kerrie Sadiq. I'm from Queensland University of Technology. The paper I'm presenting today is a co-authored piece that I've been writing with Professor Richard Creever. Before I start, I do want to thank Irma for inviting us here to present this. And of course, I'm delighted to be presenting today, but I'm very much looking forward to Frederik's work. I've known Frederik for many years now, since he was a new PhD student when we first met. And of course, we have Dr. Readhead and Professor Shay online presenting their work, which will, I'm sure, be an absolute pleasure to listen to. And I understand their work is with Professor Alison Christians as well. So it's fantastic to be here, and I know we're all presenting for about 30 minutes each, and then we have time for questions. Thank you to everyone who's turned up in the room. We do have an audience in the room for those of you who are online. In addition, we obviously have people online, so I'll be attempting to talk to both audiences in our new hybrid world. My understanding is that Irma is sitting up the front and she will monitor the chat for anyone who wishes to ask questions in that way, and Irma will pass those questions on when we get to that session. So moving on now to what I'm presenting, which is what's happening with the global minimum tax proposal in terms of affecting low and no tax regimes. And obviously Frederik's talking about developing nations. So I'm focusing on jurisdictions that are a little different to purely developing nations. And there's been a significant amount of work done in terms of the effects of Pillar 2 and the minimum tax on developing nations. But when we started looking at this research, Professor Creever and I felt that there wasn't much of a focus on countries that were relatively developed but had tax policies that involved attracting foreign direct investment. And we've both just come from Qatar, where the University of Qatar in Doha asked us also to present this work because they're particularly interested in the project in terms of GCC countries. So that's part of our case study here as well. So here we go, I've got it. So why a case study? Why did we undertake a case study approach? Again, as I said, lots of work has been done around developing nations and also tax havens, obviously. What we felt with a case study approach is it allowed us to move on from questions such as, will Pillar 2 be implemented? What is Pillar 2 trying to achieve, and how the technical aspects of Pillar 2 work? We don't deny they're incredibly important questions, but if you undertake a literature review, as all academics do, you'll find nearly 100 articles already published on those topics over the last 12 to 18 months. So I'm going to touch on those topics, and I know we have a varied audience. I've looked through the registration list, and there are people certainly in the room and online who will already know the first 10 or 15 minutes of my presentation, but there are people in the audience who are relatively inexperienced when it comes to Pillar 2. So as the first presenter today, I will go over some of the preliminary matters around Pillar 2 to ensure that when we start talking about case studies, and in particular when we start talking about acronyms, everyone understands what we're talking about. And this really is a session where for 2 hours we could have a conversation in acronyms and be speaking any other language in between. So leading on from what I said were important questions. As I said, I will touch on those briefly. This presentation is done in a manner that suggests Pillar 2 will be implemented, but there are those who would ask the question as to why a jurisdiction should prepare for Pillar 2 at all. The US has stalled in relation to its introduction. It's unlikely that Pillar 2 legislation will be introduced in that jurisdiction in the near future. And I know we do have people from the US online, and in particular, Professor Shay. I'm sorry to put you on the spot, but I'm sure you're the ideal person if someone asks a question about the US position on Pillar 2 and what you believe is going to happen. Within the EU as well, there is a failure to achieve consensus on a draft directive to implement Pillar 2. Poland and Hungary have objected. Obviously, however, we have a core group of countries. They met a couple of weeks ago and agreed to implement Pillar 2 according to the common rules, but effectively unilaterally. And my understanding from conversations that we've had here is that the Netherlands is part of that group. So the Netherlands are undertaking the process of implementing the Pillar 2 rules according to what the OECD has recommended. Now, that leads on to the next point, that jurisdictions should prepare for the consequences of Pillar 2, simply because countries or jurisdictions that are home to large multinational entities will introduce the income inclusion rule that affects ultimate parent entities in their jurisdictions. And that's what Pillar 2 is about, that minimum tax which will be applied in the jurisdiction where the ultimate parent entity is located. Now, there's also a consensus that adoption by a critical mass will result in an effective globe or global minimum tax, because there'll be that push down effect. There is a suggestion that we do need jurisdictions such as China and Hong Kong on board. So, and Hong Kong is one of the case studies that I'm going to present to you today. What is Pillar 2 trying to achieve? There is a debate around whether it's trying to achieve or limit tax competition by introducing a floor, that 15%, or whether it's addressing profit shifting. Profit shifting, for those of you, and I know some of you are Irma's tax students, she would have taught you all about transfer pricing. It doesn't directly attempt to address transfer pricing per se, but indirectly it is altering the behaviour, or aimed at altering the behaviour of multinational entities. Now, this particular question, if you are interested in it, people like Michael Devereux and John Vella from Oxford have done some wonderful work. So their papers are fantastic to read. There's also debates around sovereignty issues, and in the literature, there's a debate as to whether Pillar 2 is consistent with residence and source principles, and a lot of that research is coming out of North America, Canada, and the US. There's again some fantastic reading on those issues. Personally, I sit on the side of Pillar 2 always being consistent with source rules and jurisdiction to tax. How will the technical aspects work? The main challenge according to various conversations, is centered on using financial accounting principles. The bottom line is Pillar 2 is all about rudimentary algebra. The OECD documents released on this, and I haven't gone into those, but last December, rules, common approach to rules was released. It's about 70 pages long. Then in March, we saw commentary and examples released. So I'll go through some of those formulas, but the kind of questions around technical aspects are, dealing with financial accounts, interposed entities, calculations, what's in, what's out, etc. So it's a move away from how we normally calculate figures from a tax perspective. Now, I will quickly move on to the design elements to establish what those are. Income inclusion rule, the backstop under tax profits rule. Most recently, the QDMTT was introduced, the qualified domestic minimum top-up tax. It technically isn't a core part of the GLOBE rules, but it is contained in the OECD documents, and it really is a substantial part of these rules. So I will be talking about those a little more, and I have no doubt Frederik will be talking about the QDMTT for developing countries as well. Within that is the substance-based income exclusion, the SBIE, which is a carve-out, and it effectively alters your figures quite significantly and really brings to light the fact that the minimum tax of 15% isn't actually a corporate income tax, but rather a profits-driven tax. And substance-based income exclusion allows multinational entities to carve out a certain amount that is seen to represent genuine activities in a particular jurisdiction. Now, on top of that, we have the subject to tax rule, the STTR. That's going to be a treaty-based rule that will be relevant to developing nations. That is still being developed by the OECD, so they're still doing work around that. In terms of the various steps being undertaken, this is a diagram that I've simply taken from OECD documents that runs through the process of identifying groups within the scope. And the scope is entities which have turnovers of more than 750 million euros. So we're talking very large multinational entities. Determining income, attribution of constituent entities, and it is dealt with on an entity by entity, a jurisdictional basis, dealing with those entities. Unlike the US GILTI rules, and again, with Steve Shay online, perfect opportunity to ask him about that. I've dubbed Steve in again. These are all questions I'd like to ask Steve as well. And Ali, obviously, who will be completely on top of this. So then it's a case of applying the rates, the top-up tax, and determining what amount gets included under the IIR or UTPR. So the income inclusion rule is the rule that applies tax at the ultimate parent entity level. And if a jurisdiction doesn't introduce the GLOBE rules, then the UTPR is the backstop or the second rule. Key formulas, these are going to be key to the GLOBE rules. The top-up tax, working out the top-up tax rate times adjusted GLOBE income minus SBIE minus QDMTT. As I said, we could talk in acronyms for 2 hours. The top-up tax rate is 15% minus effective tax rate. So the tax that's already been paid in a jurisdiction. And the effective tax rate is adjusted covered taxes over adjusted global income. Now, everything I have asterisks up on those slides is defined somewhere, and I'm not going to go through those definitions because it would take a considerable amount of our time. What I do want to go through, however, is the QDM-TT, and the OECD has stressed that jurisdictions should be considering the QDM-TT as it is an essential part of the GLOBE proposal. When we're in Doha, David Bradbury, who happens to be Australian, but working in this area at the OECD, spoke, and he very much stressed the importance of the QDM-TT. Introduced into the model rules released in December 2021, it's hard to find anything that suggests it existed before that date. But its most notable feature is that it will take priority over the two main rules contained in these rules, the income inclusion rule and the UTPR. What the QDM-TT does is allow a jurisdiction to put in their own rules consistent with the GLOBE model rules to ensure they get the first bite of the cherry. So if an entity in their jurisdiction is not being taxed at a minimum rate of 15%, the QDM-TT will be activated and it will top up the tax to that 15%. So in our case studies, where we're looking at GCC countries, as I said, I use Hong Kong as an example, that QDM-TT is going to be essential. The other amount that is going to be essential for jurisdictions that are, say, low or no tax jurisdictions, or low tax jurisdictions trying to attract investment is this amount known as the qualified refundable tax credit, or the QRTC. A qualified refundable tax credit, you think about them in terms of government grants. They're treated like a direct government grant. So what they do in terms of the calculation is that they don't actually reduce the amount of tax that is treated as being paid for the purposes of determining your effective tax rate. So they don't fully reduce it, but rather they're added back into the denominator so that they're treated as income. And that means that the effective tax rate is reduced slightly, but not as much as it would be if you had non-qualified refundable tax credit that are taken into account in reducing the tax already paid. Common example, research and development. So research and development incentives, additional tax incentives over and above the normal tax rate. So they will be the common one used. The final amount that you should be aware of before I get into my case studies is the substance-based income exclusion. Now, the SBIE is an amount that you reduce, obviously, the income, the GLOBE income that has the rules applied to it, the top-up tax applied to it, and it allows you to reduce that income by ultimately 5% of the carrying value of tangible assets located in the jurisdiction, and then 5% of the payroll costs for employees that perform the activities. So real economic activity in the jurisdiction. So if you're getting genuine foreign direct investment into your jurisdiction, not just money being channeled through transfer pricing mechanisms, but work is actually happening in the location, then you get an exclusion. Now that's starting at a higher percentage and being progressively reduced over a period of 10 years down to that 5% rate. So it starts off with a carve out of 10% for payroll and 8% for tangible assets. But this is the ultimate rule that we'll get to. So moving on to our case study approach, as I said, we've got 3 case studies here. The first one that we look at is a jurisdiction with restrictive source rules. Obviously, Rick and I come from a region that is much closer to anywhere in Asia than it is pretty much anywhere else in the world, including the EU and broader Europe. So the first case study we chose is based on a case of New Fair Holdings and a commissioner. It's the commissioner in Hong Kong. So it's actually a Hong Kong case. Rick and I have written a case note on this in Tax Notes International if you wish to read more about the case. Why we also chose this case, apart from the fact that we'd already done some work on it, is that Hong Kong is a fantastic example of a developed jurisdiction. It is known to have a low tax rate, but it actually has a tax rate of 16.5%. So it's above that 15%, which is what the Globe rules are aimed at. But it has incredibly restrictive source rules. Now, the ultimate reason for choosing this case is we were coming here, and it involves a Dutch company. So again, if you want to read what Dutch companies are doing in relation to Hong Kong, go and have a look at our article in TNI where we go through the full set of facts and the Hong Kong court decision. And as I said, it was only handed down earlier this year. What happened in New Fair is that there was a Dutch company importing goods from unrelated suppliers in China. But they rerouted money, not necessarily goods, but money through Hong Kong. And it's a really simple transfer pricing story. That's all this case is about, is a simple transfer pricing story on the facts. So they transferred the goods from China to Hong Kong through a related entity, markup of 35% sold to the Dutch company. Nothing happened in Hong Kong. It's just purely transfer pricing through this intermediary firm. Now, if the scheme was successful, and ultimately it was, it meant that a substantial portion of the Dutch firm's profits would have been shifted from the Netherlands, and your company tax rate at the time was 25%, to Hong Kong, where the tax rate was 16.5%. So you immediately go, well, this makes no difference to the Globe rules or the income inclusion rule, even if the Netherlands introduces such a rule with the ultimate parent company in the Netherlands. But in fact, the company was super greedy and sought a bigger tax savings and said that all the profits derived by the Hong Kong firm, remember the related party firm, were exempt from Hong Kong tax. So it's completely exempt. This is the diagram of how it worked. And I didn't come up with this diagram. You'll see I've acknowledged the source, KPMG did this diagram nicely. I was going to do one and decided not to reinvent the wheel. So you'll see, third-party suppliers in China, but Newfair incorporated in Hong Kong, parent company sitting up the top in the Netherlands. So really stock standard kind of arrangement for transfer pricing purposes. I just said that the taxpayer claimed that the profits were exempt in Hong Kong. How did they do that? Hong Kong operates a territorial company tax system. So very, very narrow. Newfair claimed it had neither carried on a business in Hong Kong nor derived profits from a source in Hong Kong. So they said that all of the profits were outside the Hong Kong tax base. So essentially we were going to end up with what we call in international tax terms stateless income. Hong Kong works on a precedent system based on the UK decisions. Judicial precedents established by the Hong Kong courts said that two conditions for profits to be characterised as arising in Hong Kong needed to be met. They were, the profits must have a source in Hong Kong and be derived by a business carried on in Hong Kong. Now, essentially, the court said that the contracts were all that happened. There was no business being carried on in Hong Kong. There was no source. In fact, the taxpayers were so blatant that in court they said, we just set this up as a shell company for the purposes of taking advantage of the tax rules. And the court went, yes, you did, and yes, it works. So this income wasn't taxed anywhere. And as I said, if you want to look at the granular details of the case, Rick and I have written that piece if your students want to have a look at it from a Dutch perspective, because obviously this looks at it from the Hong Kong perspective and what's happening there. Interestingly, not that we've heard, certainly the transfer pricing arrangement has never been challenged as far as I know in the Netherlands, and obviously Revenue Authority here could do so. So what are the risks to Hong Kong? There potentially is a case for finding that the tax authority here in the Netherlands could say that the Hong Kong company has a permanent establishment here because the owner's located here and the everything's done here. But the issue as well is Hong Kong has broadly supported the OECD's international tax reform agenda. They're part of the inclusive framework. They don't fall into the OECD's list of tax havens. It has a full information exchange process in place. In 2018, it enacted new transfer pricing provisions. It codified the rules consistent with the OECD, introduced country-by-country reporting. It looks like it's doing everything right. It's not a developing country. It's just operating these arrangements because they have this territorial system. However, Pillar 2 potentially changes this. So what are the possible responses to Pillar 2? The question is whether Pillar 2 would apply. That would require the Dutch parent company to be subject to the income inclusion rule. It assumes the Netherlands enacts Pillar 2, but as I said, there's every indication that you are going to do so. If that happens, the benefits of the arrangements to Mayfair is lost, subject to various thresholds, but Hong Kong still fails to collect the tax because according to their territorial rules, according to that case, the income isn't located in Hong Kong. So what could they do? They could certainly alter their source rules. There's currently precedent that says that the income isn't located in Hong Kong. They do have the corporate income tax rate of 16.5%. The issue there is that even if they change their source rules, the base rate, the headline rate for corporate income tax is quite often very different to your ETR or your effective tax rate. So your effective tax rate generally is considerably lower than your headline or base rate. So Hong Kong would have to be careful of that. They could introduce the qualified domestic minimum top-up tax, and that is the suggestion on the way jurisdictions like Hong Kong would go. The other thing they could do is by still having a system that attracts investment, providing a qualified refundable tax credit. You remember I said that goes into the denominator, so it doesn't affect your effective tax rate as much as reducing taxes. But how would they do it on an arrangement like this? There is no substance in Hong Kong. It was all done for transfer pricing. So no substance whatsoever. And then we have the question there, what about companies in jurisdictions that do not adopt Pillar 2? So, and I've suggested the US there as something we could look at on what happens to a case like this if you had an ultimate parent entity in the US undertaking this arrangement. And there are ways that going through partnerships governed by Chinese law, escaping subpart F and possibly guilty. And Ellie and Steve will know a lot more about this than I do, but there is a suggestion that perhaps it might still work for these kinds of taxpayers. So in the time I have left, I've probably got about 5 minutes, is that right? Or,
yes.
Okay. In the time I have left, I've given you the Hong Kong, Netherlands scenario there. The time I have left, I want to move on to GCC countries. So, and they're my other two case studies. So GCC countries, low, no tax rate countries, Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, UAE. Incredibly wealthy countries because of their natural resources. In fact, they tend not to care about tax. They just don't need to care at this stage. But they do care about attracting foreign direct investment. So what would GCC countries have to consider? They would need to consider in-scope taxpayers, so who comes within the rules in their jurisdiction. As I said, multinational entities with global turnovers of more than 750 million euros will be caught. There are some excluded entities as well, not-for-profits, governmental agencies, etc. In-scope income always has to be considered. Most income of the entities included will be captured, but things like international shipping is the notable exception. So international shipping income comes out, and that's particularly valuable for multinational entities that run several different businesses if they can take that income back out. And then assess the types of incentives offered. Now, if you're wondering what kind of tax rates these countries have, you'll see that Bahrain has 0 at the moment. They don't tax at all. UAE is going to introduce a tax. Bahrain's proposing to, but nothing solid. Where Rick and I just were talking about this research, Qatar has a current rate of 10%. So they're particularly interested in what they can do about it. I talked about the fact that treaty rules will be brought in as well, and there are obviously quite a high number of treaties in those jurisdictions that they're going to have to worry about. So before we jump into these case studies really quickly, what could GCC countries do? And we've come up with 6 options based on the literature and the work already done. Obviously, they don't have to do anything. They could maintain the status quo. They're certainly not being as proactive as, say, the Netherlands in jumping on board because they just don't have those ultimate parent entities in their location. What they're concerned about is the foreign direct investment side of things. So they could just do nothing. They could introduce a QDMTT, consider the design of their incentives, increase existing corporate taxes to ensure the minimum ETR is 15%, but it is incredibly difficult to work out where that point is, especially given incentives and exemptions. Implement broad-based corporate income tax regime that applies to all businesses, or they could implement a bifurcated threshold-based corporate tax system to only capture at a higher tax rate entities that fall within the globe. So case study 2 is our special economic zones, SEZs. These are incredibly significant in the Middle East, in those GCC countries. We were in Qatar, so we talked about the SEZs, but when you look at somewhere like the United Arab Emirates, they have 47 SEZs. Saudi Arabia has 28. All of these countries, except for Kuwait, are part of the inclusive framework. So they have to get that balance as well. Now, what's happened previously is these SEZs have been assessed as part of the harmful tax practices program of the OECD, and they've been assessed generally as not harmful. Sometimes there's special provisions, but essentially they're not harmful. And then suddenly now they're realizing they're going to be captured in these Pillar 2 rules. So one that is there is the Qatar Science and Technology Park, QSTP. I've got some pretty pictures of the various companies who are operating out of that particular SEZ that are familiar to all of us. So what's going to happen? The potential way that these SEZs are looking at minimising the impact of Pillar 2 is to get that exemption, the SBIE, for substantial activity. And if you look at the SEZs, they do have a requirement for real economic activities to be carried out. And the statement that I have up there that I won't read out is specifically in a QSTP document about investing and coming in. So they have people on the ground, not a lot of assets, more people, but that will be a way for them to get around it, to have a carve out. Now, they're also going to have to assess their concessions. And this diagram, it was initially a fantastic group of researchers coming out of the University of Vienna who coded the concessions into green, yellow, and red in terms of impact in a report that ultimately they did and fed into a United Nations UNCTAD World Investment Report on International Tax Reforms and Sustainable Investment. So this isn't my work. Again, the slide got a bit big, but in the paper we've acknowledged those two sources, and I've adapted it slightly into those particular categories and the relevant ones for these jurisdictions. So what is going to be the impact of Pillar 2? Tax exemptions for these SEZs are going to lose their attraction because quite often there's a tax holiday or a complete exemption. Accelerated depreciation and loss carry forward rules, if they have those, will remain effective, and other incentives will be affected to various degrees. What they will be looking at using is substance-based carve-outs, as I said. But also what they're looking at is shifting to incentives that are less affected by Pillar 2. So your capital intensive type incentives, or reducing taxes that are not covered by Pillar 2 to the extent that they have a bearing on investment decisions. So what is most likely to occur? That's up in the air still, coming from that jurisdiction. They don't know themselves. Final couple of slides. Case study 3 is our reduced tax rates. And again, you'll remember that we have some fairly low tax rates and some no tax rates. And even Kuwait, Oman look like they'll be fine at 15%, but in fact, that's the base rate, so they won't be. There's no suggestion at this stage that they will do nothing. No suggestion that they won't do one, that they will do one, but there's also no suggestion of raising tax rates whatsoever. So what is most likely to occur? A QDMTT seems to be the way they will go. And I apologise, I've gone a little over time because I gave the introduction for those who don't have a good grasp on Pillar 2, and that brings me to the end. Thank you.
Thank you. It is okay because I was just checking in the chat. We don't have any questions at this stage from the chat, but do we have any questions here in the room? Please go ahead. No with the questions, but come in. Do you have any questions? Anyone? No. Let me see. Yes. Steve? Shay has a question for you.
Steve should have answers, not questions.
So, Steve, you're asking, do you want to ask the question yourself, perhaps so people can see you? Or?
Either way, I was just asking if Kerrie knew whether anyone has modeled the practical impact of the qualified refundable tax credit. So, and I noticed it wasn't sort of explicitly put on your slides of GCC responses on that one slide, but I'm just wondering in what circumstances might it be helpful, in what circumstances might it not, if anybody knows. Thanks.
Yeah, thanks, Steve. I'm not aware of any modelling. The closest I'm aware of is the work that Michael Devereaux, John Vella and their team have done out of Oxford, where they give pretty rudimentary examples of how it will work. Rick and I spent 2 days in Doha talking to people about this, academics, people from the Revenue Authority, and we didn't get any feel that they had done that kind of modelling at all. Rick is in the room as well. Steve, Rick, I don't know if you wanted to comment on that at all, but our conversations in Doha didn't suggest the revenue authorities have done it.
Microphone pick me up from here?
Yes, yeah.
You hear me, Steve?
I can, thanks.
Oh, that's pretty impressive technology you guys got. That's great. Well, look, nobody knows because nobody knows what anybody's going to do. So it's hard to do modeling without just a complete guess what people will do. But just to give an example of the variations that are available, in the Hong Kong case, obviously, if it looks like the Netherlands is going to have, say, a top-up tax, Hong Kong would presumably want to have some sort of top-up tax, except they wouldn't want to apply the top-up tax to any Hong Kong company because they'd want to keep it that they still have residence-based, or rather territorial basis tax, and they don't want to have any tax on that, on the foreign source, the local income that's transfer pricing type income that they're able to shift offshore under their rules, like the case that we looked at. So they want to have a rule that applies to Netherlands companies, but not Chinese companies, because at this point they haven't talked about having any top-up tax, and not Hong Kong companies. So the rule would just be inconceivably complex to start identifying different companies which are subject to a top-up tax and which aren't. And I think that's the reason we have no modeling, because the rules are just going to be so impossibly complex, it's impossible to guess what they might look like.
So can I unpack that just a little bit?
Yes, please.
And make sure I'm following. The reason the top-up tax would apply to the Hong Kong companies, I take it if you take the narrowest form of top-up tax, so it only applies when there would be a top-up tax in some other jurisdiction. The companies that are headquartered in Hong Kong, so where the top parent company is Hong Kong, those companies could possibly be picked up by a under tax profits rule of collected by an affiliate of that company in another country that does apply Pillar 2. So that's one concern that you're raising that I hadn't thought about. So thank you. But that does depend on how many of those there are. And so all of this ends up being to some extent a quantitative question in the first instance, as your presentation, I think, very clearly set out, which is who are the companies in the jurisdiction, how many of them are affiliates of companies that apply a Pillar 2 rule, or have affiliates that are companies that apply a Pillar 2 rule. And that sort of sets out the initial framework. But otherwise, the Hong Kong companies that would be affected would be affiliates, not top companies, but affiliates of groups that are subject to the rule. And there, because the IIR would potentially be going somewhere else, it's not clear to me why you would not want to apply a QDMTT. So that's what I think you're too quick for me, Rick, and I'm just trying to make sure I understand the logic.
Well, we've got three groups of companies in Hong Kong. We've got the vast majority of them are going to be Chinese owned. We've also got a lot of entrepreneurs in Hong Kong with Hong Kong companies. So we don't need a rule for those people. At this point, we don't need one for the Chinese companies because China doesn't seem all that concerned about taxing Chinese companies because they're all state-owned companies in any case. So what we're talking about is we're going to enact a rule for Australian, American, and Netherlands companies, which is an awfully strange rule, isn't it? It's saying there's a million companies in Hong Kong and we want it to apply to 1,200 companies. And the rest of the affiliates we don't care about.
But I thought you could adopt a QDMTT that only would apply when there is a top-up tax.
Yeah.
So if your first two categories are not subject to top-up tax, they remain under the current situation. It's only the third category that would be affected by a narrowly drawn QDMTT, which does seem permissible under the model rules, I think, that would only kick in when a top-up tax would be paid.
Yeah, no, sorry. I agree entirely. But the Hong Kong revenue system cannot operate working on a case-by-case basis, looking at every company and every transaction. So they have to have a set of regulations that says, here's where it kicks in, which means Hong Kong authorities have to figure out whether the Dutch are going to apply it in this situation to this company. And they have to somehow draft regulations because the Netherlands aren't going to apply it to every affiliate every time. They're going to have complex rules on that, which somehow now have to be replicated in the Hong Kong rules because their top-up tax is only going to kick in if the Netherlands would have otherwise taxed it.
Okay, I don't want to take more time unless others allow us to pursue this. Irma, you're in charge.
Thank you so much, Steve. I think that since we have still you also presenting together with Alexandra, and we have Frederik, so we will stop the discussion here, but that's also, you guys can continue. It's really nice to have all these discussions. I know that for some of the students could be very technical, but this is the way we have now the rules. And even though we try to explain it as easy as possible, but sometimes it's difficult. Okay, we do have another question, but I will just take that one to the end, because I want to give room now to Frederik Heitmüller, who is PhD candidate at Leiden University and the project GLOBTAXGOV. And he will discuss about designing a minimum tax that works for developing countries. Open questions and possible solutions. So Frederik, the floor is yours.
Yeah, thank you very much. So what I will present is some work in progress. I have not yet carried out empirical research on my own on that questions, but yeah, mainly due to the research that I'm doing for my PhD thesis on the impact of that 1.0 projects in developing countries. Oftentimes in discussions, for example, people that I was interviewing there, they would ask me, so what do you think about Pillar 2? What should we do with it? And usually my answer was that I don't know. It's a difficult thing, and I still don't really know, but I have engaged with some literature on the topic, and yeah, given some thought to what is actually missing so that we can answer that question, and that's what I just want to share right now. So one might think, well, the question if the fact that countries in the mainly developed world, in Europe and US, possibly in China, the fact that they adopted Pillar 2, a global minimum tax, is this a good thing for developing countries? So this question, one might think it's not so relevant anymore, because it's gonna happen somehow anyways, and we already have the model rules. But I think towards the future, we can assume that at some point there might be future reforms, there might be some tweaking for the details, and the questions such as, for example, whether the rate should be higher or lower, whether these substance-based carve-outs are good, if there should be sectoral carve-outs and things like this. This might still change or might still be subject to debate in the future. And at least I think it's therefore good to still keep giving thought to this question, whether it's good at all, this minimum tax, especially because, at least from my perception, there's also not really a common agenda from developing countries. The opinions, what I've seen, are quite diverging, with some organizations such as ICRIX, who say that the rate is actually too low, it should be much higher. But other academics, for example, or also people, tax advisors, for example, from developing economies, often say the opposite and say, no, that should not be there at all. So so there's not really a common voice by those people who pretend speaking on behalf of developing countries at all. So I just try to decompose a little bit this debate in this presentation, and just for purposes of this presentation, I assume that good here means maximizing both foreign direct investment and tax revenue into developing countries considered as a group. I think my assumption is that that's more or less what most people have in mind as well, who are giving different, who are advocating for different things with regards to Pillar 2 and developing countries. But of course, it can be debated whether that's really what good is about. So my idea is basically, I should also mention that what I'm talking here mainly is the aspect that really relates to putting a floor on tax competition of Pillar 2. Like Kerrie mentioned, that we have these two aspects, tax competition or just addressing profit shifting. To some extent, I think they are related, but so what I'm going to talk about is like putting this floor to the race of the bottom. And I think it makes sense that that we first ask, why do developing countries would adopt lower tax rate to attract foreign investment? So, for example, through special economic zones or through low rates across the board. Usually it's just specific incentives rather than low rates. But I think it makes sense to decompose that into two aspects, into two effects. One, which I would call the compensation, and the other is the beggar thy neighbor effects. So talking about compensation, that's the thought that lower tax rates could compensate for lack of other factors that investors are looking for, or that affect their risk perception, such as the market, the infrastructure, the political situation. Could also be geography, the skill level of the employees. So countries think they give a compensation to that by lowering the tax rate. And the other effect is just trying to undercut jurisdictions that are at more or less at the same level of these other factors, which are more or less the factors that that can define why this country is a developing country and not a developed country. So this basically concerns competition with developed countries, and this is competition among developing countries themselves. And if we think about maximizing investment and tax revenue in developing countries, actually this first effect, it should still be there. So if we want to, if the levels should converge among countries, then it would be beneficial if some investment could be diverted from more developed countries to less developed countries. But the other effect, of course, it's not beneficial if we just think about maximizing investment into the developing countries considered as a group, because it would just probably result in a giveaway to MNEs and then increase profits that are redistributed to developed countries, because it might just reallocate investment among countries of the same level of development. But now, of course, the difficult question is, how big is each component, and how could one design a minimum tax that discriminates actually between both of these effects and just eliminates one by keeping the other. So for the technical implementation, there's some literature that talks about this. One is a rather old text already by Margaliot from 2003, who basically suggested that something that tax competition should be eliminated, but on different levels, with a higher level for more developed countries and a lower level for less developing countries, basically forcing more developed countries to adopt a higher tax rate so that lower income countries are actually able to effectively compete. So they talks about Ireland. Of course, if Ireland has a low tax rate, it's very difficult for a developing country to still undercut that low rate. So that's basically the idea that he puts forward there. And in a very recent article by Afton Titus, she takes over this idea and suggests that the developing countries should be exempted from the operation of the Pillar 2, so that top-up tax basically would only apply to lower tax profits that are in developed countries. This is, I would say that this is basically just one subform of this suggestion, where the level for developing countries is set as 0, but of course one can play with these parameters. The difficult question, of course, is still knowing what is actually the reality and how should these parameters be. To what extent do tax incentives really attract investment that would have otherwise be invested in developed countries, or to what extent is it just a reallocation among developing countries? This answer will be very dependent on different economic sectors. So it's very challenging to know that empirically. So I try to look a little bit into different empirical approaches that have been taken to just address the question of the effect of the minimum tax and how it would affect companies. And I have not really found, at least up to date, something that could really give direction into how this decomposition could be done. But I nevertheless wanted to share some approaches that I found that might be adapted, or that at least go into the direction of being able to answer such questions. First of all, I think it is difficult to rely on literature that has been done in the past that assesses the impact of tax incentives or of the effect of tax on foreign direct investment in general, because they usually rely on data that has been done in a world that is quite different from the one that it would be under Pillar 2, so where countries have very diverging tax rates and where they have diverging systems for taxing foreign income. So I'm not really sure whether we can extrapolate from that. So what I think could be other good approaches that might be more helpful to that is approaches that exactly study the effect of different systems of taxing foreign source income on MNEs, how that affects investment into developing economies. So, for example, when a country switches from a territorial to a credit system, or vice versa, or studies that look at the effect of competition within jurisdictions. So, in countries with federal systems where different regions levy corporate tax rates, and then you can have minimum taxes or not. So I think this could be useful, directions to pursue. So I just put here also some studies that already do this a little bit, although they do not exactly address this question often because they are from before when people were actually started talking about the minimum rate. But yeah, this idea of looking at different systems for taxing foreign income is that one could think about the minimum tax, that it's just another step on the ladder of different systems that tax more or less the foreign income of MNEs. So where the territorial systems such as Hong Kong would be nothing at all, but then you have participation exemptions, you have tax sparing provisions, and so you have CFC rules, and then on top the minimum tax. So there are some studies, for example, that look at what happens when countries switch from credit to territorial, and they see that FDI becomes more sensitive to the tax rates of host countries. Also if countries adopt tax sparing clauses with certain countries, but this these studies, they do not really focus on the aggregate impact, the impact on aggregate investment into developing countries, but more what how does investment flow into different into individual countries. So this is not really useful for answering this very question, but I think it could be ways to further approximate this problem. And another avenue pursued by some researchers is to look at subnational tax competition. Germany is an interesting case because in Germany there's to some extent tax competition among municipalities which have autonomy on setting the tax rates, and in 2008, I think a minimum rate that is quite. That is not like the minimum tax now, but it's just a legal harmonization, so that countries are forced to adopt a minimum. Not countries, the municipalities are forced to adopt a minimum rate, and there's some research by Büttner and Kühnlein that looks at the effect of this and found that competition, while it has not led at least other jurisdictions to increase their tax rates, but this is not really also the question that I would be looking to answer, but it could be interesting to pursue further this way. There's one study by the OECD, Löchlinger and Pinheiro Campos, which makes an observation that countries where there is more tax competition among subnational units, that they tend to have less intra-regional differences, suggesting that that would suggest that a minimum tax might not be good at the global level, but it's only one observation based on correlation. So they see that countries like Canada, I think also Germany, maybe, where there is more federal tax autonomy, they have less inequalities among the jurisdictions, and others that are central states have sometimes more, but that's cannot really be used, I think, either to establish a causal relation between these two aspects. So, but this, I think, would be further avenues that would be worthwhile pursuing. So yeah, conclusion there, I still don't have the real answer whether the fact that GLOBE will be introduced as a good thing for developing countries or not. At least I wanted to share some factors that I think one should take into account when answering these questions, and that could maybe be taken into account in the future debate. I put the references of the articles cited here. This will be shared on our website at the end of the seminar. All right, thanks.
Thank you so much, Frederik. So then my question is to the people online. If you have any questions, just please ask them in the chat or raise your hand. And I was wondering if there are any questions here in the room. No? Oh, there is one. Let's see. Or will be me just? No.
Oh, it's
me.
just you. Right.
Yeah. So since we do not have any questions and we still have time, I would say we just take a 5 minutes break, and then just very quickly, quick break. And also for the people online, Alexandra, Ali, and Steve, we will start in 5 minutes, yeah, with your presentation.
Great, thanks, Emma.
Thanks. So, hi, Steve. And Ali. So, Alexandra, these are Ali. These are you guys. You have the same set of slides, right? Okay, then
We do.
that would be good. Yeah, we can just have it like 3 of you like this. Is that okay, Frederik?
Yeah.
Okay, good. So this is our final presentation, and then I would like to introduce you to Ali Readhead, Alexandra Readhead. She's from the International Institute for Sustainable Development, and she will also discuss about the global minimum tax and its effects on countries, and also Steve Shay, who is from the International Senior Lawyers Project, but also from university in the US. You want to say the university, or is only for the project? Or perhaps you can explain a little about the project as well. I cannot hear you, Steve.
Oh, I'm sorry. I also have a hat as a senior fellow at Boston College Law School, but for this project, I am acting as a volunteer for the International Senior Lawyers Project.
Yes. And since you have been in Leiden, you know more or less how the rooms look like. So Ali has not been in Leiden, but you have the advantage. So I leave it up to you. I don't know who is going to present first. I guess Alexandra, Ali will present first.
I think so. That's right. Yeah, we've divided the slides amongst ourselves. So thank you, Irma.
So please go ahead.
Sure. Thanks, Irma and Frederik, and thanks so much for the invitation to join you all today. So as you'll see from our first slide, so as Irma said, my name is Ali Readhead. I work for the International Institute for Sustainable Development, which houses the Secretariat for the Intergovernmental Forum on Mining, Minerals, Metals and Sustainable Development, where I lead our work on tax and extractives. So our interest in the global minimum tax came about because we were monitoring the reforms from the perspective of the impact on resource-rich developing countries, which are our primary focus at the IGF. And then, obviously it has broader implications beyond the extractive sector, although tax incentives are very prevalent in that sector, which is what prompted our interest in the first place. So we teamed up together with the International Senior Lawyers Project, specifically with Steve and with Alison Christians, to put together this toolkit or guide. Actually, we've called it now. So it's a guide for developing countries on how to understand and adapt to the global minimum tax. And we've just completed the draft for consultation, which some of you might have seen. We sent it to Irma and Frederik yesterday, unfortunately, but we're now putting it out for public consultation. So we'd really value feedback from everyone in the room, physically and virtually, in the coming weeks and months. So I'll give you just a quick snapshot of the purpose and the contents of the guide, and then Steve and I'll get into the substance. So essentially the objective here is to provide a framework for countries to think about the application of the global minimum tax to its taxpayers and the interaction with their domestic tax system in order to make decisions about whether they want to adopt or enact rules in response to GLOBE, and if so, how to go about that, how to assess the economic impact, and also to consider some of the legal issues that they might come up against. The guide then goes on to describe how Pillar 2 works, hopefully fairly briefly, and with the help of Alison Christian's excellent graphs, which I think really aid understanding immensely. Then we go through the different country responses to Pillar 2. And the impact on different sorts of incentives. So we'll talk about what we see as those responses, and we've sought to prioritize them in terms of bearing in mind kind of the challenges that some developing countries might face in terms of their ability to engage in the process, to enact complex reforms, what options might be simpler for them, and then, looking at the impact on certain incentives. Then we go through an approach to assessing the economic impact, and then lastly, the legal constraints of enacting tax reforms in response to GLOBE. And I think those two components are very important, obviously, for countries to consider the economic impact and the legal issues before deciding whether or not to adopt GLOBE or a variation of GLOBE. So the thinking is that in the guide it says, here are the different responses to Pillar 2, but which response you choose, or if you choose to respond at all, will depend on having done your economic impact assessment and thought about issues to do with stabilization agreements, investment agreements, and bilateral investment treaties. And so the thinking is that once we put this guide out, that together IISD and ISLP will be available to developing countries to help implement the guide and to undertake more kind of detailed country level work, looking at their legal framework, the economic impact and so on, in order to put this guide to work and to help them make informed choices. So I will hand over to Steve for this next slide.
Thank you, Ali. And I really should start off by a couple of notes. First, another participant on the ISLP side, and quite a valuable one, is Zach Puga, the names of the authors, I'll let Ali come back and acknowledge her team, because it's been a really excellent group representing different perspectives. The second thanks I want to give right away is to Professor Sadiq for a very clear overview of the rules. As you can see, I would have jumped right into the acronyms with my apologies, but with her presentation as background, the third item before I jump into the presentation is, as Ali mentioned, we hope all of you have received a draft of the guide, and it genuinely is a draft. We very much welcome comments on the draft. You can send them to Ali or to me, or both of us preferably, and we will be sure to circulate them and take them into account. So we value that. One comment on the draft, I think, regrettably, is it does not include in the current draft a table of contents, which I hope we will have in a later draft because it's so helpful. The first slide that Ali went through is in essence a table of contents of what the guide covers. So, and we'll be going through that piece by piece. The first major element of the draft is indeed an overview of the rules. And again, I agree with Ali. Thanks to Alison Christians, it's quite clear, and includes diagrams like that on the bottom right, but we're not going to get to the diagram right away. Our first focus is on how Pillar 2 works. And in part, we go through this potential pool of earnings that occurs in a situation where you have a very large multinational that satisfies the 750 million euro threshold, that has affiliates whose effective tax rate, as determined under GLOBE rules, is under 15%. Somebody under Pillar 2 potentially taxes that. I agree with Kerrie's, Professor Sadiq's view that once a relatively small threshold of countries adopt Pillar 2, countries such as those mentioned are looking at doing it unilaterally, it's going to be in play, in force, and have real effect, I think, for all of the countries that are the target of this work. In our discussion, we quickly get to the QD-MTT, the Qualified Domestic Minimum Top-Up Tax. And the reason for that is, I think we share the view that that is potentially the most important tool for developing countries to be able to either protect a share of revenue in their own countries, and in some cases, well, to protect the revenue bases of their own countries from any excess being taxed by another country. But we also go through what is a covered tax. And here, very importantly for developing countries, CFC taxes, control foreign company taxes, in other words, taxes imposed at the shareholder level of one of these large multinational groups that is within scope of the rules. So if we go back to the Hong Kong example, if you have a Dutch company that has more than 750 million of revenue for the group, and it has a Hong Kong affiliate. If the Netherlands had control foreign company taxes, which they do not, my recollection is correct, then that tax would come into play in determining the effective tax rate in Hong Kong. So this is a very important element. Turning to my country, the United States, the GILTI tax, I think, in its current form, even though it does not satisfy the standards, I don't believe, to be a Pillar 2 IIR, income inclusion rule, because it's not per country and a number of other reasons, it would be almost certainly a CFC tax. So for working purposes, we assume that GILTI would be a tax taking into account for the IIR at the level of the source country. Describe the UTPR, which is a backstop to the IIR, and of course the substance-based income exclusion rules that, again, both our prior presenters have described so well. Just at a very, very high level, one alternative that we focus on, and in the ordering of our guide, we put alternatives up towards the front, and because we think that it's important to have those in mind through the rest of the discussion. One alternative, and clearly a leading alternative, is to adopt a QDMTT. There are at least two important technical issues that I'll mention, but hold for questions if people want to get into them. One is, the CFC taxes, how are they taking into account? Does the QDMTT precede is it determined without taking into account the CFC tax, which I think we think is the better answer? Or is it possible that the QDMTT only applies to top-up taxes after application of the CFC tax? And the second issue, which has been, to my knowledge, largely unaddressed, and we only touch on in the guide, is what happens if a country taxes offshore transfers of stock or other assets? This is a topic of a platform for collaboration on tax toolkit, and is one that is apparently unanswered, but it's not just unanswered. There's a real risk that those taxes are not taken into account for ETR, and that needs to be thought about. The second major focus we put in the guide is on what is the effect on tax incentives and what are potential responses. Ali will come back to that. And then the third alternative we consider is adopting a broader alternative minimum tax that is not limited to the companies, that are in scope of Pillar 2. I also liked the presentation of Professor Sadiq and Professor Kerrie identifying the broken down set of alternatives, in their case for the GCC countries, but I think that's more broadly applicable. But we focus more on an alternative minimum tax idea. So in the right-hand column, I just identify, this is a kind of diagram we have throughout the guide to show very simply what happens if country A has at the top country as the ultimate parent entity has a 15% rate. If country B, the source country, has a low rate of 4%, but it adopts a QDMTT of 11%, then on $100 of income, the regular tax should be 4. The QDMTT, again, stacked ahead of any CFC taxes, would be 11. So it brings the tax rate up to 15, leaving nothing for the top-up tax. And then I'm just stop there. We could go through the upper category if people have questions about that. So Ali, do you want to take the next slide?
Sure, thanks very much, Stephen. As you said, you very appropriately acknowledged our collaborators, Zach as well, and I left off from our side, my colleague Thomas Lassord, who's a policy advisor on tax and extractives, together with myself at the IISD. So yeah, the way that, as Steve has mentioned, the way that we've set out the guide is in terms of the different options that countries could consider for responding to GLOBE. We've got a kind of narrow response, which is to be very closely aligned with GLOBE. And the primary option there, I think, is to enact a QDMTT. Of course, you could review your tax incentives in a very surgical fashion to remove them so that you don't fall below the globally agreed rate, but we tend to be of the view that that would be quite challenging, particularly for many developing countries, and so prefer QDMTT. So that's why we've focused on that as part of what we consider a narrow response to GLOBE. And then there's also the broader response to GLOBE, which is really seeing this as an opportunity to, as a springboard perhaps, to unpick various ineffective, harmful incentives, and to explore other sort of simplification measures. So in that regard, when it comes to the broad response, we look at 3 options, which is really, the first is around reconsidering tax incentives. So as I said, we don't think that this is an easy option for countries, but it's certainly, we don't want to discourage them either if they're able, if they have the resources to do this, to really look at incentives and see which of those that are going to be impacted by GLOBE, which you might need to review or to remove, and so on. And so we list them in the guide. So things like profit-based incentives, obviously income tax holidays, export processing zones and so on will be significantly impacted by GLOBE and reduce the effective tax rates below the agreed rate, versus cost-based incentives. So we kind of go through the various sorts of incentives that we would typically see and rank them in terms of the likelihood that they'll be impacted by GLOBE, and therefore would need to be reviewed if that's the approach that you choose to take, as opposed to, for example, applying a QDMTT, which overrides the tax rate obtained, tax result obtained under the domestic law if it falls below the effective tax rate. And then the second option that we look at as part of this broader response that Steve has already mentioned was the alternative minimum tax. So insofar as reviewing tax incentives might be quite a burdensome process, countries might be keen to consider an alternative minimum tax, which I think for all intents and purposes is very similar to a QDMTT, although slightly broader in nature, but it has the same effect of overriding the domestic law, and specifically the incentives that might be contained within domestic law. I think we're of the view that this is still within the scope of GLOBE, or certainly consistent with GLOBE, part of the spirit of GLOBE, and so therefore should be considered as such by the OECD. And particularly given that a lot of countries, and a lot of developing countries in particular, have adopted alternative minimum taxes in recent years, so it's kind of consistent with that trend. And then the final option that we look at is really what we debated calling this the do nothing option, essentially, which is that some countries, having done their economic impact assessment, might decide that actually we've got very few in scope multinational enterprises. There's not a lot for us here with respect to GLOBE, and so we'd rather leave things as they are. And in line with that, they might also be considering their participation in Pillar 1, because obviously participation in Pillar 2 requires that you also participate in Pillar 1, which requires that you give up DSTs. And so it may be that some countries decide, well, there's not much here for us, and in agreeing to this, we would then have to forego DST, which might be working for us, and so we'd rather keep things as they are and maintain our existing tax system, and potentially including a DST. So those are some of the options that we look at as part of this broader response. So got a narrow response, which really is intended to closely conform with GLOBE, and then a slightly broader approach using GLOBE as a springboard to consider kind of a more extensive review of tax incentives, as well as a broader alternative minimum tax, and then lastly retaining DSTs or enacting DSTs for countries that don't already have them. So the do nothing approach, if you will. I'll stop there and pass back to you, Steve.
Okay. Just one observation. We have at the end of the document an appendix that takes the breakdown of the prior slide, which is a high level sort of summary, and for which we also thank the Vienna people for their work in helping giving us a framework. But there is in the appendix a very interesting and I think personally helpful set of case studies with respect to incentives of a particular country. My recollection, Ali, is it's Uganda. And so again, we both asked for comments on that, but also I think readers will find it very valuable. So we turn next in the guide to a general assessment. The best we could do, and here Thomas Lasourde was really the primary leader on this part. What could we do from the public data to assess the impact of Pillar 2 on developing countries generally? And the three high-level conclusions are that the GLOBE top-up tax is most likely generating developed countries and developed economies and what are called low tax developing economies, but particularly the zero tax economies, the offshore hubs. Nonetheless, we conclude that there is a significant amount in relative terms for developing economies, which can only be captured by adjusting local rules where there is potential for tax. In other words, there's a low effective tax rate. We can't reach country-specific conclusions based without the firm-specific data, which leads us to the step-by-step approach on the right-hand side. Before I move to the step-by-step approach, I just would call attention and perhaps encourage Frederik to add to a bibliography two studies in connection with our general assessment that we found very, very helpful. One is from the EU Observatory Group, and that includes Mona Barake, Paul Emmanuel Schuk, I hope I'm pronouncing names correctly, Teresa Neef, and Gabriel Zuckman. So very fine work, and it is in publication, but it is now on the Intertax website, and it's in footnote 23 of our paper. And the other study that we found very, very helpful is the UNCTAD 2022 investment review chapter. There's a chapter in there on Pillar 2 and its impact on investment. And both groups we've talked with, and we found their work very helpful to understand the potential impact of Pillar 2. When you get down to a particular country, what we suggest as a kind of approach, a step-by-step approach, and I do want to take on the step-by-step idea analysis of Professor Sadiq and Creever, but where we are is compile a list of all the large taxpayers in the country. In other words, all the taxpayers that are part of a group that would exceed the 750 million. But you start with their large taxpayers because that's where the money is. Then you say, who is the parent company of each taxpayer? And see if you can identify the aggregate turnover of the group and identify then which companies in your jurisdiction are potentially affected by Pillar 2. Then calculate the SBIE for each of these firms. So which ones are actually going to be subject to the top-up tax? That is where their low tax revenues exceed the revenue that would be attributed to the payroll and tangible investment as well described by Professor Sadiq. Then some sensitivity analysis is required, but that gives you the universe of companies that are, and therefore the amount of income that in the country is potentially at stake. I think our thinking was a little more directed towards countries in the nature of countries in sub-Saharan Africa than in the GCC or Hong Kong. So I really like the complementarity of the work that is covered by the presentations here. But that's the idea that we have to say that from there, you then move on to say, well, how, now that you know your scope, come back to the options and what should you think about doing. So I turn it back to Ali to talk about legal constraints on those options.
Thanks very much, Steve. And I think, yeah, the work that Thomas and colleagues did looking at, in general, the economic impact certainly gave us all reason to pause and think about, well, you know, do countries necessarily need to respond to this, or perhaps it might not be, you know, worth their while, hence the do nothing option in our guide, or we've, you know, called it something different now. But as Steve said, the final section in the guide is around the legal constraints, and this is building on some work that we had started at ISD and IGF, thinking about the impact of fiscal stabilisation provisions, particularly in investment agreements, although it's broader in this guide. And that was, again, coming from the extractive sector, which is where I work primarily. Fiscal stabilisation is very common in investment agreements and can be a real handbrake on countries enacting reforms, including responding to the global minimum tax. So in the guide, we go through 3 sources of potential fiscal stabilisation. And you know, I'm sure most people are familiar, but those that perhaps are not, what we're really talking about here is provisions that purport to limit or can be interpreted as limiting the ability of the government in the host jurisdiction to make changes to their tax regime, and more specifically to apply those changes to existing investments. So we look at stabilisation in domestic law, in investor-state contracts, and then bilateral investment treaties. So when it comes to domestic law, here we're talking about kind of, you know, broad provisions that might offer stabilisation to investors. I think what we're more interested in is stabilisation in investor-state contracts, which we see as being slightly more problematic for countries. It's important to add that I think fiscal stabilisation in general, but particularly in investor-state contracts, is really a problem for developing countries. It's not something that developed countries usually entertain with investors. And so it is really an issue for developing countries that are looking to benefit from the global minimum tax. And in investor-state contracts, typically we see provisions that might freeze the law at the time when the contract was entered into, which might mean that, you know, obviously the global minimum tax wasn't in place when these contracts were agreed, but more particularly they often contain tax incentives that might bring the effective tax rate below the globally agreed rate. What can be done in response to fiscal stabilisation in investor-state contracts? We put forward 2 options. So the first is requiring unilateral acknowledgement from the taxpayer. I should say, before I speak to the options, the reason for this is that it's difficult to know how arbitrators will view efforts or unilateral attempts by governments to respond to GLOBE that might be in breach of fiscal stabilisation provisions. I think what we've tended to see is that arbitrators favour a strict interpretation of fiscal stabilisation provisions, but it really will depend on analysis of the precise wording in investment contracts. Having said that, what can countries do? In the first instance, require acknowledgement from the taxpayer that they will agree to waive the stabilised fiscal terms that bring the effective tax rate below the globally agreed rate. This is something that could be considered, particularly with more constructive taxpayers. The challenge that we see here is whether or not then the taxes that they pay will be considered a voluntary contribution, and so investors might struggle to get a credit from their home country. So that's something that would need to be addressed. Alternatively, countries could simply renegotiate the fiscal terms in investment contracts. I say simply, it's not simple. We're not proposing kind of a wholesale renegotiation here, but it would be renegotiation of very specific terms that run up against the global minimum tax. So that's obviously a much harder route for countries than the first option, but there's some ideas there. Then we turn to bilateral investment treaties. And here, it's not that you have fiscal stabilisation provisions and BITs as such, but that certain standards of protection might be interpreted as providing for stabilized conditions. So we go through these different standards of protection and provide our assessment of the likelihood of claims being successful under those standards. And I think I won't go through each standard because I think we're running short on time, but to summarize, I think in general, we're of the view that it's unlikely that investors would be successful under these standards of protection, potentially with the exception of fair and equitable treatment. And this really depends on the process that the host country carries out in order to respond to GLOBE and to make those changes to the domestic tax system and the contents as well. But provided that the steps that they take are not arbitrary or punitive and so on, it seems unlikely that an investor would be successful. But again, the devil is in the detail, of course, and it depends on a close analysis of the bilateral investment treaty in question. But the fact that we're dealing with a multilateral agreement, the fact that investors will have to make equivalent payments in other jurisdictions, the fact that all M&Es that are within scope will be treated the same, regardless of where they operate, I think all bodes well for countries that are looking to make changes and are potentially worried about arbitration under BITs. And lastly, we make some suggestions on proactive responses that both corporates and the OECD inclusive framework could take or could offer. In relation to corporates here, it's really encouraging them to get out in front of this, and where they do benefit from fiscal stabilization, potentially waiving fiscal stabilized fiscal terms that would mean that they have a low effective tax rate. And then on the OECD side, firstly, making sure that stabilization waivers or the waiving stabilized fiscal terms, that they could still credit the taxes that they pay as a result of that. And then requiring corporate disclosure where they have been asked by host countries to waive stabilization, so that they would have to disclose that to shareholders, putting pressure on them to, of course, grant or agree to waive stabilization. And lastly, some form of multilateral agreement that would essentially put GLOBE out of reach of stabilization. It would be a kind of binding, a document that would be binding on arbitrators, or a source of interpretation that would mean that, if these cases are escalated to arbitration, that it's very clear, there's a very clear consensus that, that GLOBE is a good thing and that it should be protected, I guess, from stabilization agreements. So I'll stop there. That is a whistle-stop tour of our guide. As Steve said, it is a draft version that we've shared, and we really look forward to feedback today, if time permits, and certainly in writing afterwards, or if people are interested to have a call with the drafting group as well, we'd certainly welcome that. Thank you, Irma. Back to you.
Thank you so much, Ali and Steve. And I think that one of the most important issues, what I also see here, and we have seen it through the whole time, is about the tax incentives. And some of my students, when we discuss about tax and investment, and we say, well, this is related. And you see through this, and especially your last presentation and your last slide, that some issues of taxation and whether to raise this minimum tax will create perhaps problems for the countries where you have a stabilization agreement. And with the stabilization agreement is an agreement, and I may explain because there are some students here, it's an agreement between the Minister of Finance, of Trade, and the taxpayer, and say, in this specific period of time, your tax will not be more than this. So what happens if you have a stabilization agreement, not only in the mining industry, of oil industry, but also in general? And what will happen then if you have this stabilization agreement and then you decide to raise the tax? And we see here is one, we have discussed that with some people, especially in Latin America, where you have a lot of stabilization agreements. And so one of the things that we can also, Rodrigo, you will get it via email, the version of the guide.
Yeah,
but
we already sent it to only to those registered until yesterday.
Then we will send it to you. So, but one of the things that we have to see this, in this case, I think that Ali is you exactly and correctly say, it will not be easy to renegotiate this stabilization agreement. So you may say we can do it, but actually at the moment that you want to renegotiate, the taxpayer will say, what is in it for me? So my advice is, what can we tell to developing countries, and especially with the ministry, and we have here some people also from the OECD, what can we tell them? What type of tool can we use to have this stabilization agreement renegotiated? Because otherwise the minimum tax will not be applicable. So Ali, I don't know, Ali and Steve, if you have looked at that, because it's what you say, it's not as easy as it seems.
If I can,
yeah, please.
If I can come back, I think there are two things that countries should think about. First, of all the developing countries, there are many of us sort of divide them into resource-rich and those that aren't, for whom resources are not the primary driver. So this discussion is oriented more specifically to resource-rich countries, and those countries in turn need to say which firms are potentially involved that would be affected if they adopt a QDMTT, for example. And then the question is, companies, if they're faced with the decision of paying a QDMTT to the country where they operate, or paying an IIR to their parent country, or paying a UTPR to yet a third country, are almost always going to prefer to pay in the country where they operate. So this is why we put this idea of approaching a company and asking them to waive the application of a stabilization clause with respect to the Pillar 2 taxes. And the idea is they're going to pay tax anyhow. I had a discussion with the senior vice president of tax of one of the major global mining companies, just off, not in front of a microphone. And he was very clear. Yes, it's very clear to me, we would rather pay to the local country. So I think that's a step that's not a legally important step, but I think our experience is companies are often in dialogue with the countries in which they're operating. These investment agreements are not negotiated, then put on the shelf. It's like they're in constant tension because people are saying, did you do this or did you do that? So there's a real opportunity here. Ali, did you?
I think, yeah, just to add to what you say, Steve, we also were very careful in this guide that we don't want to over-egg this as a problem, because it's certainly, stabilization agreements are a concern in general, not just in relation to the global minimum tax. But I think we're mindful that this issue is really relevant for a subset of countries, a subset of investments, and it requires careful analysis to see whether these stabilization provisions, whether the terms that they stabilize actually do bring the investment below the agreed rate. So I think it's certainly an issue that we need to take note of, and we'd like to see the OECD take a stronger position in relation to stabilization agreements, and ideally in the commentary to, as I said, put out a message to arbitrators and so on that the intention here is to waive stabilization so that countries can benefit from GLOBE, but we didn't want to overstate it as a problem, because I know sometimes we can put up all these barriers and countries end up saying, oh, well, we don't want to do this because it sounds a little bit too hard. So it's an issue that we need to be aware of, and there needs to be a response from the OECD to this issue, but we need to be mindful that it only affects quite a small number of investments, I think.
Thank you, Ali. And I think that here Kerrie would like to say something. My apologies.
Hi, Ali and Steve, it's Kerrie here. Thank you so much for your presentation. It was fantastic, and I'm so pleased you're doing this work, and I haven't read your draft yet, but I really look forward to doing it. One thing we've stayed away from is the subject to tax rule, the STTR, and perhaps that's because we all don't know quite what's going to happen. But when Rick and I were in Doha, the practitioners were particularly interested in it. And you would have seen on my slide that the GCC countries have a lot of tax treaties. And we know that's going to take priority over the IIR and the UTPR. Their questions were around the interaction, and particularly in relation to whether they implemented a QDMTT and whether those amounts would count towards minimum payments for the purposes of the STTR. And several other people were asked as well, and the responses tended to be, it's complex. And I noticed, STTR, recognise data away from it, and it's not yet in your draft. I'm wondering 2 points. One is whether you've considered the interaction or whether you're just staying away from it in your draft. And the second is obviously the developing countries that your team has all looked at, and then the GCC countries that we're looking at are on opposite sides when it comes to the STTR. So I would love to hear your comments around that.
Yes. And let me, before Ali and Steve, because we also have one question here from Rick, and we have one from Jennifer Farrell in the chat, but Rick, please go ahead.
Yeah, okay, but I actually have a 3-part question. That will be really fast. The first one is just Ali, you might think about this in your list of stabilization agreements, that in my part of the world, the main type of stabilization agreement is a production sharing agreement, which doesn't quite fit in, and yet it has the same effect. And you might just want to think about what you're going to do with all the countries that use that all of their income comes from production sharing agreements, and that's a lot of resource-rich companies with no income or very little income tax. And then just two little things for Steve. One is beware of American concentric thoughts or approaches, so that when you say, for example, mining companies would rather pay tax in, sorry, I'm looking at the screen, of course you're back there somewhere, but it's easier looking at your face as I talk. When you say mining companies would rather, or any company would rather pay, well, let's take a mining company, would rather pay tax in, because that's the example you used, would rather pay tax in where they do the work and where the mining is, as opposed to the home country. It would be exactly the opposite in much of the world. Certainly in Australia, if an Australian mining company ever paid tax in Africa, the directors would be out of a job tomorrow, because the owners are my pension fund, and my pension fund pays tax in Australia and wants the imputation credit. So they want all the tax paid in Australia. So that conclusion is true for some countries, but not for a lot of countries. If there's any imputation system in effect and so forth, there's going to be a lot of other factors that affect it. But finally, just a technical question, just to expose my ignorance here. And you can explain this when you're answering Kerrie's question, but Steve's slide had the 4 plus 11. So the national tax is 4, and then you want to add 11 to get up to 15. But aren't these on different bases? Isn't the tax base for the 4 taxable income and the tax base for the 11 the actual income? In which case, to get the total up to 15 on actual income, it might have to be 12 or 13, or it might have to be a lot higher than 15, depending on what the actual tax base is, isn't it? Yeah, that's the one.
Thank you so much. I will just give first to reply to these 2 questions. Steve and Ali.
Yeah, no, thanks very much, Rick. Yeah, production sharing agreements, we've considered that as part of our previous work at IGF on this topic. I think my understanding from the OECD is that production sharing agreements will be, production sharing will be considered covered tax because it's in lieu of corporate income tax. So I think it's certainly within scope of the GLOBE rules, and agree with you that stabilisation agreements are just as prevalent there as in, tax and royalty system type investment agreements as well. Steve, did you want to?
Yeah, Rick, love your questions. Actually, I think it's not the tax director, senior VP I referred to actually wasn't a tax director of a U.S. parented company. But your point, I think, is extremely good one, because it may show not the centric, US centric, but the tax centric. When you talk to a tax VP, you get what they care about most. And you're raising a point. It may not be what the CEO cares about most, and they have to worry about shareholders and those other considerations. So I think that's a terrific point. But nonetheless, I think when you also combine that with the potential for public sensitivity as to where the tax should go, I think it's in the overall best interest of the multinational to pay a QDMTT to the source country, but I take your point. On the second point on the slide, thank you for putting it up. You are absolutely right. This is a very, very simplified version, assuming that the globe tax base and the local tax base are close enough that the numbers work. And I think that's something we need to make clearer in the guide. And the numbers may well work out quite differently depending on the tax base. So I take that point as well. Nonetheless, I think the nice thing about a QDMTT is that at least it fits the top-up tax. How it fits in with the rest of the crediting, I think, is a very, very good point. On the other hand, that is US-centric, since so far a few countries credit outside of the Pillar 2, other than the United States, and our rates aren't so high at this point. So let's hold on that and come back. On the STTR question, we tended to downplay it in the guide. We haven't given a lot of time to it. I think Kerrie's questions are great. I would be a little shocked if the QDMTT were not taken into account in applying the STTR, but I have not looked at that enough to express a strong view.
Thank you so much. There is one final question. I see that there's some also discussion in the chat, so I will just put it in a second. But Frederik, please go ahead.
It's just maybe something that could also be taken account in the guide. Kerrie's question brought me to the question of withholding taxes levied by developing countries, how this affects, on the one hand, the calculation of ETR, and also the issue of the economic impact assessment. From what I recall, is that in the CBC, from the CBC guides, it was to me not always clear in which countries these withholding taxes are reported, actually, the country where it is paid, or the country on behalf of which entities is actually paid. So this might potentially affect these calculations. It was just, for me, it would be super interesting to read about that.
I don't know if Steve or Ali would like to react, or if you guys are okay.
Ali, you want?
No, I just agreed with Frederik, and we'll make a note and something to think about, I think, in the next iteration.
I think it's important. A very important question. I would, again, under a rational approach, the tax would be treated as a tax of the source country. So I guess I haven't thought enough about it specifically to be comfortable answering right here. So we'll dig into it. But my intuition is very strong. That should be the tax of the country imposing a withholding tax.
Yeah, and I think the final comment that we have in the chat is that the side of trade, because actually what they say also, Jennifer, here is that we have to take into account that if we are moving away from the tax incentives, is there are frustrate as well trade. And with this in mind, then I think that we will end this seminar. Thank you so much, everyone, for being here, to Steve also, and to Ali for giving the presentation, and here to Kerrie and Rick and Frederik, and to all the participants. And there is a final meeting, but I think that, yeah, there is a reply to Heitmüller. Okay, good. So thank you so much, everyone, but it's 4 p.m. so we always try to be on time. So please, it has been nice, and we will be making this recording available for everyone. Thank you so much. Bye.
Thanks, Irma. Thanks, everyone.